the supply response, in our view, is completely underestimated by the market. The supply challenges are real. And for those investors and owners who are already set into high quality real estate, we think they will get some outsized benefit because you're not going to get the usual supply response you would get when rents increase like we expect they will. In terms of downside risks, look, if you'd asked me that 2 years ago, I would have said it's the valuations, but we are now very much at that inflection point. We've seen underlying sectors such as industrial and logistics already bottom at 30 June, convenience retail 6 months prior to that, and even the office sector. We're seeing valuations increasing in core markets such as Sydney and Brisbane CBDs, and even up in the Brisbane Fortitude Valley market where rents are growing very strongly. I think the biggest risk, and I've seen this before in my career, is that retail investors tend to wait till they see a number of years of positive valuation growth come through. The big institutional investors tend to invest earlier in the cycle. And what I think investors should look at is this is a great entry point. And if you wait a couple of years, you've probably missed some of the best returns that the market has to offer.
In terms of spurring new heights, look, I'll probably give you a different answer than you asked me a week ago. If you asked me today, given the state of the economy and the fact that it's unlikely we'll see rate cuts next year, probably see rate rises, is the flood of capital that is looking for return. So one of the biggest growth drivers for private credit historically has been the fact that the listed equity markets have been lackluster. It looked like that was changing. It looks like it's going the opposite direction next year. So there will be all this investor capital, general family trusts, SMSFs, all looking for a safe place to park capital. And that will be very, very good for private credit. In terms of risk factors, I think it's just the ongoing issues around disclosure. I suspect, very unfortunately, there are some bad actors that will go under. I expect it to be focused on the property development side, but a capital loss is a capital loss, very devastating for investors. Number one, and number two, unfortunately, the media reports private credit as a catch-all. The property development fund fails, all private credit is at risk, so the report, and that will put investors off. And it's our job as fund managers to educate the market and be on the front foot to say, this is what we do and this is how we're different.
So when I think about 12 months, we're talking about from an investment perspective, a relatively short period of time. But when I think about the key things that could drive these assets, particularly the share price side of these assets over the next 12 months, call it into 2026, what we're really talking about is a couple of big things. One is that it really depends on how the economic story develops from here. Obviously, there's plenty of uncertainty as we sit here today, particularly in places like the United States, as to how we progress from here. And there's a lot of question marks as to the strength of the US economy. What is interesting from our perspective is, from certainly a relative perspective, infrastructure versus, say, general equity investments, is that if you saw economic weakness, we would expect that the infrastructure companies in which we invest would hold up particularly well in that environment versus the broader market. So we'd expect that would be sort of call it a relative positive. Now, that is not to say that infrastructure would not decline at all. You'd see the share prices go down, but the underlying earnings would not be as much of a decline. You'd expect that to be supportive. The other thing that we certainly think about, sticking on that sort of macro lens, is the path of interest rates. We're certainly less, call it fixated on the path of short-term interest rates. But for us, what we have experienced is that the longer-term interest rates tend to have a reaction with the share prices. So you'll find that when interest rates go up unexpectedly, that can have an impact on the share prices in the short term. For better or worse, the market trades some of these companies a bit like a bond proxy. Now, I'd add as a long-term investor, that can create opportunity for us, and it certainly has in the past if share prices overreact. But that's something that could happen. And then the black swan one, that's kind of interesting. The part that could play out here is, I spent a little bit of time thinking about how we've got the growth in data centers really benefiting some of the utilities businesses in which we invest. What you could see happen, and obviously right now we're still seeing hyperscalers and cloud companies talking about growth in CapEx numbers. But if we saw that sentiment shifted and CapEx was pulled back, you could see at the margin some of the growth coming through those companies slows down to a degree. I think there'll be always things to backfill with these companies, but you could see that slow down over the period. And I think that would sort of create a sentiment issue. But I would say, again, I expect there's probably other pockets of the market that would be more concerned about that than the regulated utilities out there. So I hope that gives you a bit of color to some of the things that we're certainly thinking about over the shorter sort of time horizons.
I guess in the last year, we've seen inflation easing. Interest rates were trending down. We saw strong population growth. And that, in combination with supply challenges, expected to limit new stock. The fundamentals there were to support a positive outlook, and still are there to support a positive outlook for commercial property. And this is, I guess, supported more recently by the fact that the MSCI index was showed across all four major fund types, being office, retail, industrial, and diversified, all recording capital growth in the September quarter. Now, this is the first time this has occurred since, I think, late 2022. However, September inflation data, which came out just recently, showed an increase to the annual headline inflation, which I think was to 3.2%, and increase in the annual trimmed inflation, which I think was to 3%. Now, we know that trimmed inflation is the RBA's preferred measure for underlying inflation, and this recent increase was effectively above expectations, and it not only softened, but pretty much eliminated market expectations of another rate cut this calendar year. So inflation could create some headwinds in 2026, but nevertheless, we believe the core principles of commercial property providing benefits to investors remain in the long term.
I think next year is going to be a more challenging year for some of the listed childcare operators, and most equity analysts are forecasting that. That said, towards the end of the year, I think we'll see the impact of the 3-day guarantee, which has been introduced by the Albanese government, start to come into effect. So the outlook from sort of Q4 next year onwards is actually very positive. So I think there's going to be some occupancy challenges sort of the start of next year, and then towards the end of the next year, I think we're going to see some significant improvement.
The dilemma for Australia is that we now have seen 3 years consecutive of net negative earnings growth for corporate Australia. That hasn't prevented the market from reaching a new all-time high, but that means that a lot is riding on next year's forecasts and the outlook for next year. Now, the irony here is that in that growth outlook, AI might still be a very important component, whether we like it or not, because we're now living in a context where at the very least, the RBA is not in a hurry to add more rate cuts. And that might mean that we are looking towards a rather sluggish domestic economy. Now, the irony is that a lot of companies that haven't generally participated in this bull market over the past 3 years, can they then participate next year or this year when the outlook for next year might actually not be that fantastic? Being Australia, obviously resources, energy companies are always very important. We are counting on the fact that interest rate cuts by the Federal Reserve and stimulus measures by China are keeping the forecasts positive for next year. That might be the obvious catalyst to get the index to higher highs next year. Offsetting everything I just said, we are going into the midterm elections next year in the United States, and traditionally that is the least favorable year out of the 4 in a presidential cycle. So I think here too, I would have a lot of question marks going into 2026, and I think keeping an open mind and being flexible and nimble, that would be my best approach.
I think one area that people need to potentially focus on is currency hedging, and this can be both a tailwind and a headwind. Right now, we're seeing around about 30% of ETF flows in terms of global share ETFs going into currency hedged vehicles rather than the unhedged component. Traditionally, it's only been around 10 to 15%, which to me says that currency is going to be a very important part of portfolios, and potentially with the Australian dollar finding a little bit of a floor at the moment at about 65 cents, there could be a bit of a detractor on returns for those who would just solely remain in unhedged versus their hedged counterparts. So it's not a sexy area, but there could be some potential headwinds in terms of the currency hedging component. And then in terms of tailwinds, I said it before, but I really do think that we are going to see a rise in people looking for more bespoke tactical exposures to some huge structural megatrends. And one of the biggest ones we are seeing is around the monetization of AI, which I spoke to before. I think there's a lot of companies who are trying to embed AI in their everyday practices, and people are talking about AI being in some sort of bubble. Again, I don't see signs of that because there's meaningful revenue and earnings coming from it. So in order to get a basket of AI stocks or to get exposure to AI, I think a lot of people can go to the mega cap tech companies, which are, huge hyperscalers, but also look more broadly. And I think leading into 2026, one tailwind we're going to see is a bit more market broadening. So make sure you have your exposures to these different areas, which could be the next benefactors or the next leg up when it comes to AI. So headwind in currency hedging and a tailwind in the monetization of AI.
The adoption of technology, and particularly AI, that presents a great opportunity in this space, but also a potential downside that we need to consider here. And by that I mean AI and technology is providing the opportunity for us to have greater oversight and provide greater governance around the investments and the firms that we're investing in, which allows us to run more compliant and profitable businesses. And also utilizing technology and AI allows the businesses to be more profitable off the back of the fact that we can increase margins and have less sort of labor-intensive businesses, if you like. Where that also presents an opportunity as wealth transitions from the owners of assets today into their children and beyond, we're seeing now that those consumers of advice and those that are taking financial planning and investment advice are adopting technology better and turning to AI. So what's really critical for an advice practice of the future is to really consider technology and to consider the way that they're engaging with their clients and delivering advice in ways that are of benefit to their clients. So that's what we're seeing in terms of opportunity and risk. The thing that keeps us awake at night from a risk perspective is really governance, right? And making sure that the advisors that we're working with and the firms that we're investing in are providing the right types of services to their clients and are doing the right thing by their clients. And we spend a lot of time on that due diligence and governance to ensure that those firms that we're investing in have that alignment in the way that we go about doing businesses and the way that we see things.
It's always hard to come to a conclusion as to which way markets are going to go, and we do want to have a all-weather portfolio that can take those shocks or benefit from upticks in the market. Obviously, the deterioration of the tariff risk over time this year has been a positive. Hopefully, that can continue into the next year and deliver further strong gains for the market, with Donald Trump hopefully keeping world trade in sort of a calm environment. When we look at our portfolio, the one risk that we are, I guess, less exposed to would be the AI stocks. We've definitely still got exposure, but we're significantly underweight when you look at the benchmark. And we think that tailwind is a fantastic driver of markets over the long term. However, given the prices of some of those stocks, we're just wanting to be a bit cautious on that sector at the moment, and that could derail things from where they are, just given the high prices that we're seeing for some of those stocks, albeit they are great companies.
One of the biggest factors that will continue to support our asset class in 2026 is the ongoing structural undersupply of housing across Australia. Migration remains high, construction costs are still elevated, and government incentives continue to stimulate demand more than supply. We've already seen national price growth over the past year, and with Brisbane and Perth still leading and Melbourne showing early signs of recovery, we expect residential values to remain resilient heading into 2026. On the headwind side, the key focus will be the December quarter inflation print, which comes out at the end of January, and how the RBA responds in the first half of the year in terms of interest rates. If inflation remains sticky, we could see the RBA maintain tighter policy for longer. which would place some pressure on borrowing capacity and moderate price growth. That said, given the underlying supply constraints, we still don't anticipate a meaningful decline in values. With over 10 years of experience through multiple market cycles and more than 95% of our portfolio secured against Australian residential property, we continue to see a constructive outlook for our asset class in 2026, supported by strong fundamentals and a limited downside risk.
I think we need to first appreciate that we're finishing 2025 on a difficult note with inflation having broken out again. We've gone through the disinflationary process now of the transitory impact of the pandemic. And now we're seeing cost push inflation re-emerge, not just in Australia, across the developed world to greater and lesser extents. But here in Australia, these recent inflation readings are very worrying. The end of the October reading, the headline CPI was 3.8%. And the outlook is for the RBA's trimmed mean number for the December quarter to come out at 1% for the quarter, or an annualized 4%. That is a long way above the 2.5% mid-target that the RBA uses. So in a higher inflation environment, we would obviously be avoiding fixed rate bonds. They've already moved up quite dramatically over the past 3 weeks. The Australian 10-year bond at the long end of the curve has moved from a 15 basis point discount to the US 10-year to a 60 basis point premium, which is a terrific jump. That has mostly been due to the unwinding of the euro-yen carry trade and seeing Japanese selling about longing. At the short end of our curve, the move has been 50 basis points at the 1-year bond higher. That's a reflection of the higher inflation readings and the outlook and the expectation now that the Reserve Bank will be considering interest rate increases perhaps as early as the February meeting, but more certainly by the May meeting. And there are forecasts out there that expect 2 interest rate increases now next year. So that's one of the risks. The second risk in fixed income land is the credit margins. As we enter towards the end of the year, credit margins are incredibly tight, floating rate credit margins. They're tight at a senior level with 5-year major bank senior at 70 basis points and tier 2, major bank tier 2 5-year at 132 basis points. Now, to give you a little bit of an idea there, that blew out to near 300 during the trust budget crisis in November 2022. So there is always a risk of something happening and credit margins expanding. Those risks are geopolitical, but they're also economic. We could, in an economic contraction, we'd see default risk rise and we'd see credit margins widen. So right at the moment now, there isn't a lot of potential alpha that can come out of being long either floating rate credit or fixed rate credit at the moment. So is there opportunity then for investors in that? I think the option value, the value is in staying at the short end of the curve, accepting a lower yield in the short term, so that there is an optionality there of taking advantage of a spike in fixed yields or an expansion in floating rate credit sometime in 2026. That's the opportunity. But in order to take advantage of it, we have to be patient and wait for this to happen. It's a time to be to be accepting lower yields and being careful.
So I think the factor that will positively impact our sector, which is property, would be around reduction in red tape next year from governments. I think one really important thing is that governments are trying to enable more housing supply, which is one of the biggest challenges in the market and very well documented at the moment. So governments, particularly the New South Wales government, with some of the housing rezoning and some of the enabling factors, they're really trying to cut through some of the red tape things, which I think have incrementally taken over the sector over the last few years. So from our point of view, real positive for us when you're looking at opportunities, looking at funding possibilities in the sector. A cleaner pathway into being able to enable some of those assets to be realised becomes a really important thing. So things like builder markets, they're harder to turn. Cutting red tape is a really simple thing which government seems to be actively trying to really tackle at the moment. And I think that'll flow through in 2026 when you see more housing coming out of the ground. On the tailwind side, look, interest rates, I think, are the biggest interesting thing at the moment. I look at the opportunities. Consistency on interest rates is always the most important thing. You know, they can often go up and down, but I think the outlook a couple of months ago was probably to have a consistent rate environment for the next few years. We would have definitely welcomed that because you can set your investment strategy very clearly based on an interest rate cycle that is consistent. Now we're looking at what potentially might be some rate rises or, you know, maybe more vulnerability in what's happening in interest rate cycle. That lack of consistency, I think, is what becomes more challenging for our environment. So, look, changing interest rates do create opportunities as well as challenges, but I think for us, consistency of interest rates would have been far more preferred. So I think that's probably our watch this space section of the market for next year.
So where are we heading in 2026 for Bitcoin and bullion? So that's what we're doing, Bitcoin and bullion, gold, silver. We think that really there's going to be a whole lot more uncertainty coming in 2026. When we look at those asset classes, obviously there's this underlying trade that's been going on, the debasement trade that everyone's talking about, where you've got gold and silver and Bitcoin for that matter sort of rising on the back of uncertainty around what the US is doing in particular with their debt situation. So that'll be at play. But we've also got the backdrop of global liquidity changing. So how global liquidity is made up is changing a little bit. We've had historically central banks driving that, and that seems to be changing progressively towards treasury departments and governments really driving that directly through targeted spending. So we're not entirely sure how that plays out with the asset classes and where that sort of pushes that liquidity, but we are bracing a little bit for more turbulence and more uncertainty ahead over the next year. So that's sort of the base view. What would change that if we see real clarity coming out of the US government in particular about that central bank sort of spending, that central bank, well, not really spending more, easing coming back in force? That would be a really positive sign. That would be a change. And probably to the negative too, if we see no news and we see that Treasury is really not putting the same amount of liquidity into the market that we've been getting from central banks, that would be a real jolt to the system to the downside. So probably middle of the road is where we're expecting it, but there's certainly possibility for either of those extremes if we see those sort of policy actions coming out of it.
One factor that I think could drive positive performance in 2026 for our sector, being the small to mid-cap part of the ASX, would be the performance of the NASDAQ and in particular the tech and growth stocks on the US. I say that because I think that part of the US market has a very impactful performance on investor psychology, both in Australia and the US. I think if we have a situation where the NASDAQ continues to perform really well in 26, that should be positive for investor psychology in the small to mid caps, which typically look to the US for a bit of market leadership. So I think the NASDAQ could be fairly important for investor sentiment towards small to mid caps in 26. In terms of something that could be a negative headwind for our sector in 2026, I think the obvious one would be what the RBA does with interest rate policy next year. Obviously, in 2025, we've been benefiting from the flow and effects of interest rate cuts. With inflation now being above the targeted range for the RBA, we're now unfortunately looking like we might be having at least one rate hike, possibly more in 2026. Historically, interest rate hikes have been a negative headwind for stocks on any stock market, and I wouldn't expect next year to be any different. So I think a really important thing for investors to focus on is what the RBA does with interest rates next year.
Looking ahead to 2026, one key positive is the increasing recognition of FX as an asset class in its own right. More investors are starting to look beyond traditional assets for diversification, and FX strategies can play a meaningful role in that context. As awareness continues to grow, this creates a supportive environment for FX strategies over the medium term. In terms of headwinds, there's no doubt that ongoing global, geopolitical, and economic uncertainty could lead investors to adopt a more cautious approach at times. But this is not unique to FX and may impact the broader investment management industry as a whole. Another challenge is that while growing awareness can drive interest, a relative lack of familiarity with newer or less established managers could be a headwind. Building trust, visibility, and understanding takes time, particularly in competitive markets like Australia. So overall, while there may be challenges, we believe the continued evolution of FX as an asset class and its role within diversified portfolios provides a solid foundation heading into 2026 and beyond.
The biggest driver of investment returns next year and probably through to 2030 is without a doubt the $1 trillion freight train of spending that's headed for the AI economy. So if estimates are correct and the global AI spending tally rises from $390 billion US this year up to $540 billion next year, that's US, and then surges as high as $3.4 trillion US dollars by 2033. If that happens, then the strongest earnings growth and therefore the best investment returns should probably come from the key benefactors of this massive build out. So what does that mean? It means chip makers, data centers, as well as companies supplying the raw materials needed to build out all this infrastructure. So silver, aluminum, nickel, gold, these areas, they're really going to probably see some really stellar returns. The market is telling us that too. Look at the NASDAQ 100 and the Aussie miners. Our estimates are that those two areas are probably going to see some of the strongest earnings growth next year. But markets, of course, never go up in a straight line. Next year is probably going to be a very bumpy, wild year. So we'll probably see some pullbacks, and they could come from a whole array of reasons. Maybe we get weaker economic growth to renewed geopolitical tension, or maybe louder concerns about the AI bubble. But whatever happens, either way, we'll probably see pullbacks. However, investors will be probably buying into key high-quality stocks in the key themes that we're speaking about. Pullbacks will probably be viewed as buying opportunities for the brave long-term investor, because that's how we've seen most investors build out generational wealth throughout history.
A key positive factor for our asset class is the starting point for relative valuations in the high-quality investment-grade corporate bond market, especially compared with other asset classes such as private credit and equities. After the recent backup in yields on account of the new CPI monthly release, investors now have the chance to enter the market at yields in the high 5 to low 6% level on investment-grade credit. Now, compare that with private credit funds. Spreads there have been ground lower by the ever-increasing number of entrants into the sector, and now you're only picking up a margin of about 3 to 4% over cash. When you adjust for the sacrifice you're making in credit quality, liquidity, and optionality in terms of refinancing, we think that the pickup into private credit doesn't appropriately compensate investors at this juncture. Similarly, equity investors are now staring down the barrel of a forward dividend yield of around 3.3% on the ASX 200. When you adjust for franking, that probably boosted to about 4%. We think the pickup of up to 2.5% in annual yield by moving into a structurally senior part of the capital stack with additional downside protection compared to equities seems like a decent trade at this particular point in the investment cycle. When you throw in the phasing out of the bank hybrid market over the next couple of years, it does feel like the corporate credit market does have a number of structural tailwinds at this point in time. However, no outlook is without risk, and heading into 2026, we see a key risk being the technical supply backdrop, especially when it comes to the Magnificent Seven bond issuance to build out their AI ecosystem. These companies could account for an additional 10 to 20% in net supply in the US investment grade market. And this has the capacity to widen credit spreads or even impact the overall government bond market yield, given the sheer magnitude of the issuance. Ultimately, whilst relative valuations in credit stack up well against other asset classes, we'll have to be nimble and adjust to the new technical supply backdrop heading into 2026.